Jerry Walker, CPA here, founding member of Coburn, Cheshire and Walker CPAs, to discuss the new Trump accounts. If you have children or grandchildren, you may be particularly interested in this topic. Now, the new Trump accounts were created by the One Big Beautiful Bill Act, signed into law in July of 2025. At their core, Trump accounts are simply traditional individual retirement accounts, also known as IRAs, for children. Now, Trump accounts are not designed to be a college savings plan. If your goal is for college savings for your child or grandchild, you should be using a 529 qualified tuition plan. Or if your goal is to provide a first car or first home for your child or grandchild, you should be using an UTMA or UGMA account. But if your goal is retirement planning, then Trump accounts are the vehicle of choice for you. Now, who can we open a Trump account for? First of all, the child has to be under age 18, have a social security number, and then an election must be filed to open the Trump account. That election will be filed with the IRS, and the account will be opened by the United States Secretary of the Treasury. In other words, you're going to be opening these accounts with the federal government. You are not going to be opening these accounts with your local financial advisor. Now, there are special rules that will apply until the year in which the account owner, which is the child, reaches age 18. For example, rule number 1, there are limited investment options. You can only invest in low-cost funds that track U.S. stock indices which promote long-term growth. So think about a low-cost ETF that's tracking the S&P 500. Rule number 2, if your child was born between January 1st, 2025 and December 31st, 2028, the federal government's going to kick in that $1,000 of free money. Now, you can open a Trump account for a child who was born in 2024. You're just not going to get the $1,000 of free money. Now, there are special contribution limits as to how much you can put into a Trump account. We will explain those details in later. This is very important. There are no distributions from Trump accounts before January 1 of the year in which the owner reaches age 18, with the only exception being, heaven forbid, the death of the child. There is no tax deduction for contributions to Trump accounts. So even though I may choose to contribute to my grandchild's Trump account, I will not receive a tax deduction for it. Now, in the year in which the child reaches the age of 18, all of those limitations and rules I just described cease to apply, and from that point forward, the normal traditional IRA rules will apply. So, for example, we've got the limited investment selections, right, under age 18, but in the year in which they turn age 18, those go away, and now the normal traditional IRA investment limitations apply, which is a very broad range of investments. So how do we get money into Trump accounts? Well, number 1, back to if the children were born between 2025 and 2028, we're going to get the $1,000 of free money. You will have some states, maybe cities or counties, who are going to make contributions to Trump accounts of their citizens. We think that will be limited by class and zip code. Likewise, there are already charities. For example, the Dell Foundation has said they're going to make significant contributions to Trump accounts, but there again, they're going to be limited to certain classes and zip codes of beneficiaries. Number 3, employers of the parents of the child. So if I work for a company that is generous, they can put in up to $2,500 per year into my child's Trump account. Now, the 4th category is all other contributors. So that's parents and grandparents, even the child themselves, for that matter, anyone. So if you like my grandchildren enough, you could contribute to their Trump account. Now, there's a $5,000 limit annually for 2 categories of contributors. Number 1, that's the employers and other contributors combined. So, for example, if my employer does put $2,500 into my child's Trump account, that means I can only put in an additional $2,500 for this year for a maximum of $5,000 for the year. So there's going to have to be some cooperation, because I could foresee a scenario where, let's say, a baby is born and the grandparents of the mom want to put in $5,000 and the grandparents of the dad wants to put in $5,000. Well, we've got a problem because we can't put $10,000 in 1 year. So, maybe grandparent one is going to say, I'll put in 5,000 this year, you put in 5,000 next year, and we'll just alternate every other year. So we've got to be careful that we coordinate with these employers and all other contributors so that we do not exceed the $5,000 annual contribution limit. Now, the money that's coming from the government or the charities does not affect the $5,000 limit. That's just over and above. There's no limit on how much the charities or the government can put in. The $5,000 limit applies to employers and that other list of contributors. Now, no contributions will be made prior to July the 4th, 2026. That is the date that the federal government will start putting in the $1,000 for the children born between 2025 and 2028. And that's the first date at which we can make contributions as well. Now let's talk about the tax aspects of these Trump accounts. Because the contributions coming in from the parents and grandparents are not tax deductible, the owner will be accumulating an after-tax basis in the Trump account, which will be recovered tax-free when the money comes out on a pro rata basis. I have an illustration, and I think you'll be able to see that quite clearly. Now, there are a couple of unfortunate, unsettled tax questions related to Trump accounts. Will the Trump account owners, which is the children, have to file annual tax returns and Form 8606 to track their after-tax basis in the account? If I make a non-deductible contribution to my traditional IRA, I have to file a Form 8606 to track my after-tax basis. So does that same rule apply to the after-tax basis in the Trump accounts? And at the moment, I think the answer is yes. I am hopeful that the IRS will issue some guidance and say, no, there's going to be an exception for Trump accounts, but they haven't done that yet. So that's something we will be keeping an eye on. And if we get any notification that there's been relief granted, we will issue an update and a notification to let our clients know. Second, a very similar type problem is that do the parents and grandparents have to file a gift tax return every time they give to the Trump accounts? Well, under the current reading of the law, I think the answer is yes. In fact, we believe that these contributions to the Trump accounts do not qualify under the annual exemption. So when you give to a Trump account, it would actually subtract from your lifetime exemption amount. Now, this is a terrible outcome. I'm sure Congress did not intend for that, but at the moment, we don't have any guidance that says that there's going to be an exception for this. So again, hopefully we'll get an exception very soon, and if so, we will make an announcement. So let's consider this example. Little Billy was born on January 1st, 2025. During 2026, his parents made the election with the IRS to open the account. So the federal government is going to kick in the $1,000 of free money. His parents also decided that they will contribute $5,000 per year, the annual maximum, for 16 years. In the 17th year, one of their employers became generous and put in $2,500 into Little Billy's account. Now, in that 17th year, the parents have to be careful that they don't go over the $5,000 limit. They just decided they would not contribute anything at all for year 17. They feel like they've done enough in the first 16 years. So, after the 17 years, we have a total of $83,500 which has been contributed into the account. $80,000 came from the parents for $5,000 a year times 16 years. That $1,000 came from the IRS and $2,500 came from the employer. Now, Little Billy's after-tax basis in his account is the $80,000 that was contributed to his Trump account by his parents because they didn't get to deduct the money, and so that's what created the after-tax basis in the account. So let's further assume that the $83,500 will double in value by the time Little Billy turns age 18, and so that would total $167,000. And that's actually a plausible scenario, I suppose. And then let's assume that at age 19, Little Billy has reached the age of majority, can make his own decisions. He's the owner of the account, and he decides to cash out the account and go on an around-the-world voyage, and there's nothing the parents or grandparents can do to stop him. So he does that. Now let's look at the tax ramifications of that decision. Now he's going to cash out the $167,000, $80,000 of which was from his parents' after-tax contributions. So that will come back tax-free, but the remaining $87,000 will be taxable. Now where did the $87,000 come from? Well, $1,000 of it came from the federal government, $2,500 came from the employer, and the rest was just the growth inside the account. Now let's assume for purposes of this example that the tax rate is going to be 15%. It may be more, it may be less, but for purposes of example, we've assumed 15% federal income tax. But because Billy is spending this money on non-qualified purposes, he's going to be subject to the 10% early withdrawal penalty that applies to IRA withdrawals. Because remember, after age 18, this is taxed and treated just like a traditional IRA. So once you add the 15% income tax, the 10% for the 10% early withdrawal penalty, you get 25% total tax and penalty. You multiply 25% times your $87,000, and little Billy's going to owe $21,750 with his tax return as a result of his cashing out his Trump account. Now, little Billy may be still happy to say, okay, well, 167 minus my 21,000, that still leaves him 145,000 and some change to go on his around the world voyage. But there was quite a penalty and tax to be paid to make that happen. Now, I hope that little Billy is responsible enough to file his tax return and pay his taxes before he leaves the country. Because if he, heads across the pond and doesn't come back for 4 years, when he gets back, it's very likely there's going to be a very nasty IRS letter waiting for him, because the IRS will have known about this distribution and they're going to want their tax and penalty. All right, let's change the example a little bit. Let's assume that little Billy, has become more wise and responsible. So instead of doing the around the world voyage, he's going to use the $177,000 for qualified college expenses, for tuition and books. And that is exempt from the 10% penalty. So in this example, we still got the same $167,000 he's cashing out. We still got the same $80,000 that's tax-free from the parents' after-tax contributions. We still got the $87,000 taxable that's coming from the federal government, the employer, and the growth in the account. We still have the same 15% income tax rate. We just don't have the 10% penalty because qualified college expenses are exempt from the 10% penalty. So 15% taxes, he'll be paying $13,000 worth of tax. Now you might say that's not too bad of an outcome, because he's now got $167,000 minus $13,000 to pay for college. And to some extent I would agree, but I will also say this. Had those same contributions been put into a 529 college savings account, the entire distribution would have been tax-free and we would have saved the $13,000 worth of tax. All right, so what are the options after age 17? Well, number one, and I believe this is what the accounts were created for, is just to let the IRA continue to grow and use it for retirement after age 59 and a half, which will avoid the 10% penalty. Option two, which actually intrigues me a little bit, maybe during his 20s, little Billy should convert a portion of his Trump account to a Roth Trump account each year while he's in a low tax bracket. Now, this conversion will be subject to taxes, but if he's in a low tax bracket, he just pays his tax and moves on. The converted amount is not subject to penalty, and once the money gets into the converted Roth Trump account, he will not have to pay tax on the growth as long as he leaves it in there until age 59 and a half. So this may be the best option on the page. Option number three, and we kind of saw this in the previous illustration. What if he cashes it out but uses it for items that are not subject to the 10% penalty, like qualified college expenses or $10,000 for the down payment on a first-time home purchase? So this is not a terrible option, but we are still paying some tax. And of course, the worst option of all, which I am fearful is going to happen more often than not, and that is the child is not going to be responsible. They're going to cash it out, use it for non-qualified purposes, and be subject to tax and the 10% penalty. And I just hope that they file their tax return on time and pay their tax on time. How do you open a Trump account? Well, the first is the website, trumpaccounts.gov. The account is up right now, but not accepting applications yet. I know they'll open that up soon within the next month or two. And I believe that's the preferred method. You're going to want a login to this account anyway, because you're going to want to log in and make sure the money is there. So this would be the method that I would recommend. But your other option is to file Form 4547, either by attaching it to your 2025 tax return or by mailing that form directly to the IRS. So here are my conclusions. Number one, figure out what your objectives are. If your objectives are to save for your child or grandchild's retirement, then Trump accounts are your vehicle of choice. I will be honest with you and share a little personal perspective. I'm not overly excited about that. I do believe in helping children get a start in life. So, saving for their college or maybe their trade school, maybe helping them get their first car or their first house. I do believe in that mission. But once I've done that for them, I feel like they should probably, earn for themselves, be responsible adults, and save for their own retirement. I realize there's different perspectives, and there may be some different situations where maybe the child's going to be unable for a variety of reasons, to save for their own retirement, and you could achieve the retirement planning through the Trump accounts. But that's just something for you to think about. Now, for those children born between 2025 and 2028, it is going to be difficult to turn down that $1,000 of free money. However, these unsettled tax questions really bother me. If the children are going to have to file an annual tax return in Form 8606, that's going to create quite an administrative burden and some cost. Or if the donors are going to have to file annual gift tax returns, likewise, that is going to be quite burdensome. So hopefully we get relief very soon on those two issues. If this information has been helpful to you, please like and share with your family and friends. We always strive to provide practical, legal, ethical tax advice. And I hope you are having a great day.